Ready? Okay, so we're back on our mock exercise, and this time we're going to do intercompany inventory and land profits. And we're going to actually do consolidation incorporating these transactions. So far, we've looked at questions that just did not incorporate any transactions. And this time, we're actually going to incorporate perhaps intercompany transactions with respect to entities in which a parent controls. So this question is a question called paste, waste, and based. So let's read it together. Let's read a question together, and we can walk through the question, and then we can actually see some of the key elements of the question. So first of all, we've got an income statement of paste and its subsidiary. So we know this is the parent. So I'll put a P beside it. And this is subsidiary 1 and subsidiary 2. Or let's call it waste and base. It doesn't matter. And the waste and base was prepared for the year ended year 6. So this is the year end that we're working with. And these are the financial income results for the 3 companies. So there's a couple of things to note. So you see that they receive dividend. So there's a dividend income. I always pay attention to that. And normally when you get some sort of interest and rent, oftentimes, but not always, these are probably intercompany. So I'm going to put the word interco with a question mark because I'm not sure yet. I need to read the question, but clearly you could see that the 10,000 kind of looks like it's a good match, isn't it, to perhaps waste, paste, charge interest to waste. Okay, now let's read through it. So we know that paste purchased 80% interest of waste. So let's, I like to, again, I'm a visual learner, so I'm going to draw P owns 80% of W. So let's call it P and W just to make it easier. And we need to know these information. This is the date of acquisition. So that's going to be extremely important because we're going to actually, hopefully, calculate the purchase price discrepancy in the original acquisition from P to W. But here, this question, we were given the fact that we already they've already calculated the acquisition differential, and they said at 15,000 that was allocated entirely to plant with estimated remaining life of 8 years. So we're going to need to know this. So this is the AD, and this is the 8 years. Okay, so the AD is 15 divided by 8 years. And because we bought in January, there's no proration. And no proration of the first year AD, because we saw that, right? So let me expand this a little bit. All right, okay. So the second is paste paste P purchased 75% interest of B. So let's write that down. Okay. And again, we need to know these because this is 80, this is 70, and we bought it in year 3, December year 3, which is the same as January 1st, year 4. So that's important to note. And on this date, the retained earnings is 80,000, so we need to know that too as well. But this time, they gave us the acquisition differential allocated to goodwill. So this is the AD. So AD is 19,000. And because B failed to report adequate profits, then goodwill was entirely written off in year 5. So this is important. So the write-off is in year 5. All right? So the first two bullet points gave us a great understanding of the relationship between P, W, and B. And you can see that you need to draw a diagram to showcase how the relationship works. And this question just happens to have two subsidiaries. So most of the questions you'll see are essentially one sub. Parent and sub relationship. But it doesn't matter because we're going to solve this problem and you can see how similar it is if we're solving two subs or three subs, subsidiary versus only one sub. Now, it says, parent establish a policy of intercompany sales, and this is important because that's the gross profit, okay? So that's the gross profit of 30%. We're going to eliminate any intercompany profits that remains on the balance sheet of both the parent or the subsidiary as we consolidate the financial results. Now it says that on January 1st, year 6, so this is the beginning of the year, inventory of paste contains purchased from waste. So this would be one of those intercompany beginning inventory. So I just like to write a little note. Okay, and that would be beginning inventory. And I like to put the word, now who sold it? So paste has, on January 1st, inventory of paste contained. That means that they're the buyers, paste, and waste is the seller. So waste selling. Okay? And January 1st, why? Because we're doing December 31st, year 6. Now, it says during the year 6, here are the following intercompany transactions. So you'll see paste to waste, waste to B, and base to P. So you'll see that it seems a bit confusing, but the bottom line is any transactions between parent and sub, irrespective of whether it's from sub 1 to sub 2 or parent to sub or sub to parent, it doesn't matter. We're going to eliminate the entire revenues. And we're also going to eliminate, obviously, the cost of goods sold as well related to that. Because when we're consolidating and we're reporting the consolidated results of paste, we want the revenues and cost of sales to be entirely sales to an unrelated party. So we want sales to an outside from the controlling group. Now, we're told that on December 31st, year 6, the inventories of 3 companies contain the following. So you'll see that these are the contain the following. Now, this is the big ending inventory. Now, we need to know, inventory on paste, we need to know who sold it to paste. Because that's going to matter whether that actually is important because we need to know if it's an upstream sale or a downstream sale. So we need to know who sold to whom so we can eliminate the profits as we're calculating the non-controlling interest. But if you look at this, it says that paste, so if I draw the diagram, over on this side, P, I've got W and B. And what I'm told is that sales took place paste to waste. So paste sells to waste. And it says waste to base. So that's the relationship. And base to paste. So now I need these relationship to determine who sold. So if paste has inventory, that means that it must have been sold by base, right? That must have been sold by base. So let's write down ending inventory, base selling, so B selling. Just say B. Just make it easier to write. And that is 90,000. Next is we've got waste, inventory and waste. If waste has inventory, that means it must have been the P that sold that inventory, right? and that would be 22,000, so it's P selling, and that's for 22,000. And then it says inventory in base, which means that it must have been sold by W. So ending inventory, W selling. It's very important to know who sold to whom so that we can eliminate the profit that's sitting in the individual legal entity's financial statement. Okay? So that's the important relationship. So it's important for us to track the relationship of the sale, and that was given to us in this little item here. And then we can then determine at the end of inventory how much of these are we going to eliminate. Now, it's not the entire ending inventory, right? It's going to be the gross profit. So we're going to multiply this by 30%, the entire amount. That's what we're going to do. We're going to multiply by 30% to eliminate just the profit that remains on the ending inventory. Now, it says in addition to its merchandising activities, Waste, W, is in the office equipment rental business. Okay? And it says that both P and B rent office from W. And under the general and admin, expense of P and W includes rent of 25 and 14. Okay? So 25 and 14 is what we need to eliminate. And that we got, so this amounts to, so total rent, revenue, and expense we're going to eliminate is going to be $39,000. Again, I'm going to remember this. I'm going to need to know this because we're going to have to eliminate this as well. Now, moving on, so we've got inventory exchange. Okay, we've got sales, so I'm going to eliminate. I've got rental revenue, rental expenses, and then going to eliminate. Now, let's move on to the next one. It says, during year 6, paste of 10,000 interest to pay, waste, W, paid interest of 10,000 to P for intercompany advances. So again, I need to eliminate this as well because you can't show interest, revenue, and expense separately if you borrow within the related group. Now it says all of paste dividend revenue pertain to its investment in waste and base. So this dividend revenue I need to eliminate as well. So do you remember I highlighted a few items up here? Remember when we started the question I said, I bet you these dividend, rent, and interest, I would have to incorporate the elimination of it. And that's probably true at this point. Now, it's confirmed by these additional information that we found here. So we need to deal with that. Now, retained earnings on year 6 for P, W, and C were these respectively. We're going to need to know that to do one of these questions. Obviously, part B says prepare or calculate consolidated earnings for year 6. And it says P uses cost method to account for investment and uses the tax allocation. So this is important because that's what we're going to calculate, because all of these intercompany elimination, we would have to record or reflect the net after tax factors. That's 40%. So let's look at the first requirement asks us to prepare. So when you see the word prepare a consolidated income statement, it normally means you are asked to prepare a consolidated statement in good format, in good form. Now, if it says calculate, it means that they're looking for a schedule. Now, the second part says calculate the consolidated retained earnings on December 31st, year 6. That's the end of the year retained earnings. And then part C says use the criteria for revenue recognition to explain the adjustment for the unrealized profit. So why do we do it? So we're going to use revenue recognition criteria to help explain why. So we're going to talk about that a bit too. And then, of course, this is a fairly long question, and part D says, now, assuming that PACE used the equity method, calculate the cost, its income from investment. So they want to know the equity method income. Okay? So let's get started. All right, so let's get started. Let me see if I can make this thing a little bit bigger. Fantastic. Okay. So the first part is we were given acquisition differential. So the AD differential and amortization. So in this case, we didn't have to really do the purchase price analysis because it's given to us already. And we know that for waste, there was P&E, property, plant, and equipment. And we know that was $15,000. Okay, $15,000 divided by 8 is $1,875. So for year 1 to year 5, because remember, we are supposed to be doing December 31st, year 6. So because we bought the company in January 1st, year 1, then we've got to then calculate how much of the AD have we already amortized. And of course, for year 6, which is the sixth year that we're asked to do the financial statement, we're going to multiply that by 1. So there's how many more years left? So 8 less 6, there's 2 more years left. Okay? Now, for based acquisition, we know that all of that was just goodwill. And the value of the goodwill was $19,000. Goodwill, as we know, is not amortized. It's tested for impairment. So in this case, we know that from years, now we bought this in when? We bought it on December 31st, year 3. And from year 4, to 5, the goodwill was written off, right? So this is the write down. So that year 6, we got 0. Okay, so 0 values. Again, it's important for us to note that. So normally we would have to do an acquisition differential analysis, but in this case we were given the AD already. Now, the second part is we're going to analyze the intercompany revenues. It's always good to have a list. It's always good to have a list. And if you go back to the lecture notes, we talked about it. It says, here are some examples of intercompany revenue and expenses that should be eliminated from the consolidated financial statement. So in the PW and B case, we have sales and purchases. So intercompany sales and purchases, we have to eliminate 100%. So all of these are 100%. And then the interest, revenue, and expenses, we saw that too as well, right? Because in this example, P lent money, so they had interest income, so we need to eliminate that. And management fee is often another popular expenses that gets transferred to and from parent and sub. And again, obviously, we're going to incorporate that because oftentimes there are a lot of service level agreements between parent and sub, whether parent is doing, let's say, the HR aspect or the IT aspect for the entire subsidiaries, or the marketing efforts for the entire operations are done by the parent, there has to be some sort of charge between the two. And of course, this is governed by transfer pricing, issues and management accounting issues as well regarding what is the appropriate level of transfer price, etc. We're here just to note that we're going to eliminate the management revenue and expense if we see them. And of course, in this question, we also have rental expense and revenue. So these items are eliminated to ensure that revenue is only recognized when it's earned outside of the consolidated group. So this is kind of answering that other part of the question, isn't it? So remember part C asked us, use the revenue recognition criteria. And we're going to say that, obviously, for revenue to be recognized, it should be recognized based on the benefits and risks that have been transferred to an entity outside of the reporting entity. So that's the reason why, in this case, we have to eliminate these transactions, because by not doing so, we're inflating revenue and we're inflating expenses. Now, a lot of stakeholders, when they evaluate companies' performance, oftentimes they don't look at just the income. They look at also the revenue growth, for example, cost management. So it's important for us to eliminate all of these transactions, because when we prepare the consolidated financial statement, we have to prepare it from a point of view of what transactions have occurred outside of the reporting entity. So since intercompany transactions are transactions within the reporting entity, not to the outside reporting entity, they have to be eliminated. It makes sense. Okay? So the inventory that was sold, okay, so if you think about it, if P sold inventory to W at cost, then there's not much elimination, because when you add the inventories, we're going to report one inventory number anyway. But because P sold to W, or W sold to B at a gross profit margin of 30%, then the inventory that's sitting on the buyer's balance sheet that remains unsold to a third party will be inflated, and that's exactly what we're going to do next. Okay? So I just wanted to make sure I answer that question, part C, that says, use the criteria for revenue recognition to explain why we're making these adjustments. Okay? So that's in your lecture notes. Okay, so let's get started. So we need to analyze all the intercompany revenues and expenses. And in our first example, we know we had sales. And we need to eliminate. Now, how much of the sales? Well, remember, it was 90, 170, and 150 that we saw here. So we're going to eliminate that. Okay? Now, remember rent. There was also another elimination of rent. And remember, this is the bullet point that is actually buried under general and admin, and the rent expense and rent revenue of $39,000. So we need to eliminate that as well. What about interest? Well, we're told, right, the interest was $10,000. So that was this one here. During the year, paid $10,000 interest. So we need to take that out as well. And dividends. So we're told that dividends, okay, so all of PACE, this is all of PACE dividends revenue pertain to waste and base, and that would be the $43,750. So we're going to eliminate all of that too. Okay, so that's what we need to do. So this is the second step, is determine what revenue expenses. And by doing this, it's easier for us to then prepare or start preparing the consolidated financial statement. Okay, so what's next? We're going to analyze the intercompany profits. So what I like to use is a 3-column approach. I've got before tax, because we're going to adjust, right? We're going to adjust an after tax. So remember we saw that these are the points that we wanted to make. So we saw at the beginning of the year, there were inventory that's of paste contained from purchases of waste. So what I like to do is I like to highlight, I like to segregate my intercompany profit analysis between what's sitting in the beginning and what's sitting in ending inventory. So let's take a look at kind of the theory behind this before we actually dive into the problem. So in your lecture notes, we saw that if there was sales between one party to the other, we have to eliminate if that sale remains within the group, i.e., so let's say P sold to B and B sold to a third party, there's no elimination because the balance sheet does not have any what we call unrealized profit. So in this case, because the beginning inventory still has $15,000 of goods that waste sold to paste, in this case, then we need to eliminate that. And the elimination takes in the general form in the year of the sale. So in 2005, the ending inventory of P would have been overstated by the gross profit. So that's why we are crediting ending inventory. So we're going to basically restore it to historical cost. And the other side of the entry is we're going to debit cost of goods sold. So if you remember the equation, right? So if I want you to remember the equation, beginning inventory plus purchases minus ending inventory gives you cost of goods sold. If ending inventory was overstated, cost of goods sold is understated, which means that we need to restore it back by debiting cost of goods sold. That's how you need to visualize these entries. Now, this transaction, because a sale has occurred from waste perspective, from W's perspective in this question, we're going to also reverse the tax effect of that sale. So we're going to actually reduce the income tax expense because what we're doing is we're holding back that profit until P sells it to a third party. So that's essentially what we're doing. We're delaying the recognition of that profit. And of course, by virtue of doing that, we're also delaying the associated tax effect to that as well. Now, in the following year, which is what's going to happen this year, because we're going to use the FIFO basis, we're going to assume that beginning inventory is actually sold to a third party because of the FIFO basis. So again, if you think about it, the equation, beginning inventory plus purchases minus ending inventory gives you COG. The fact that in beginning inventory, which is last year's ending inventory, is overstated, then that means that cost of goods sold is also overstated in year 6. So remember, this is year 5 in this case, right? This is year 5. So now year 6, cost of goods sold is overstated. That's why we're deducting it, we're reducing it. But because we no longer have the ending inventory, because remember, that beginning inventory was now sold, we need to adjust retained earnings, and this is the retained earnings of the seller. And remember, the seller would have recorded that profit on their legal books. It would have recorded the income tax as well on their legal books. And now what we're going to have to do is we're going to have to reverse that, but keep in mind that the retained earnings at the legal level would have already recorded it, but now we're going to record it as a sale this year. That's why the debits to retained earnings. Now, in addition, because we held back the tax, now we're going to report the tax effect to that as well. Okay? So that's essentially what we're doing in the next analysis. Okay, so let's do that. So under the beginning inventory, we only had one, and it was waste selling, right? And the amount of inventory remaining on P is 15,000, but remember the gross profit is 30%. So we're going to, right, the effect of the cost of goods sold is 4,500, but because this is 40% tax rate, we're going to multiply this by 40. So I'm going to just do this to give us $1,800. And the net effect is 2,700. So it's 45 less 18 gives you 2,700. Now, we're going to analyze the ending inventory. And there were a few, if you recall. When we analyzed the information, there were three things. We said that ending inventory B selling was 90. So let's just put down base selling. That was 90,000. Again, the gross profit is 30%. Pace selling. That's 22,000 times 30%. And waste selling. So let's translate those. This is 27,000. This is 6,600. And this is 18,000. And the tax effect on this one would be 40% times 27 is 10,800. The net of tax would be 16,200. Now what I like to do is I like to add all of my ending inventory because I'm going to make that one-time adjustment. But you don't need a subtotal if you don't want to. But I'm going to do it in this analysis, okay? Now, was there any other intercompany transactions? Were there any land sale or depreciable asset? The answer is no. This was the only thing. So this is the expected amount of deferred tax or deferred charge, income tax, that I'm going to see on the balance sheet because this is now the amount of tax that I've held back. I've essentially prepaid it because for whatever reason, all of these folks have paid these taxes because those are real sales at the legal level, and now we're going to defer it and then hopefully recognize it in the following year. Okay, so let's move on. First part of the question is asking us to prepare a consolidated statement, so let's do that. So paste company, consolidated income statement, for the year ended December 31st, year 6. So let's look at it. Let's start with sales. So again, starting with sales, I've got, and again, we're going to use direct method as you've seen before. Starting with paste plus waste plus base. Now, I'm going to subtract. If you remember, I'm going to subtract the 410,000 because that was the total intercompany transaction. Okay? So I'm going to label that minus the 410. So let me label that as D. Don't ask me why it's D, but I'll show you in a minute how this all works out. Okay? And this gives us 500,000. Now, what about dividends? Well, we know from dividends it was 43,750. We're going to subtract 43,750. Let's label that G, and that's G, right? Okay, that's the same dividend as this one. Okay, and that would be 0. What about interest? So I'm just going down the income statement, go through each account, and using the direct method, analyze the impact. So in this case, we'll see that interest, we had 10,000 reported by P, but we know that interest is one of the items we need to eliminate. Let's call that F. So I'm going to take that out, minus 10,000, F. Okay. What about rent? We know we had 130,000, but we're going to take away the 39,000. Let's label that E. Okay. And that was 39,000, wasn't it? That gives us 91,000. So altogether, the total of this is 591. Now let's look at cost of goods sold. So this is cost of sales. Okay, so let's add the 3 columns again. We've got 300,000 plus 163 plus 145. And remember, we need to offset, right, the 410. That's the intercompany sales that we need to reflect, because that would have been the cost of sales, right? So think about it. If it was revenue to one, and if we sold it all, it would have been cost of goods sold of the other. But we're going to make that adjustment. Okay, now what adjustment are we going to make? Remember, there were intercompany transactions, right? So we need to adjust the fact that some of those profits, so some of these have profit that remains. So we need to subtract, right? We need to adjust for the beginning inventory and the ending inventory. So how do we do that? Well, first of all, the beginning inventory was overstated, which meant that the cost of goods sold was overstated. So now I'm going to take away the $4,500. And let's label that H. I'm going to put that as the letter H over here. Okay, so we're going to subtract, the cost of goods sold. So let's think about the logic again. If beginning inventory, this was the beginning inventory. So if beginning inventory, we know at the local level is overstated by the profit. If the beginning inventory is overstated, the cost of goods sold is overstated. That's why we're deducting it. Okay? Now, let's think about the ending inventory. If the ending inventory is overstated, then cost of goods sold was understated, and that's why we're adding the 51,600. Let's label that I. And that represents all of these ending inventory. Okay? Now, what else? What else do you think we need to do? What else do we need to do? Well, remember we had these property, remember these acquisition differential? Now, we're going to assume that 1875 is part of cost of goods sold. So we're going to label that as B, and we're going to actually adjust it. So we're going to deduct, in this case, let me think about this for a minute. It says that Differential amount 15 was allocated to plant equipment remaining life. Yeah, the plant is used exclusively for manufacturing of goods. So in that case, we're going to add the 1875. And let's label that B. Okay? So so I wanted to make sure that this acquisition differential that we calculated related to property plant, it says in there that it was used for manufacturing, which means it's part of cost of goods sold. And that's why we're adding that amortization of it. And that gives us 246,975. Now what about general admin? The general admin expenses, first we have 93,000 plus 48. This would be the P, W, and B's. Now, what do I need to deduct? I need to take away the rent, wasn't it? That was the rent amount that we said we were going to take away. So remember, we took it out here, we need to take it out of here. Interest. Okay, interest is 10,000 minus 10,000. We know that that was from F. Gives us 0. And income tax. So we know that we need to add the 3. Okay, so let's think about this for a minute, right? So first of all, we know that this inventory is now realized, and that's the tax effect of that. So we're going to add this to the income tax. But because this ending inventory, although was realized by the legal entity who sold it, the seller, but we're going to hold it back, that's why this is now deducted and set up as a prepaid deferred tax, income tax. So that's what we need to do, okay? So we need to add 1,800 and deduct 20,640. So let me label that as H and I, so that you can you guys can take a look at it after. So total expenses is 468,135. So profit would be the difference between these two is 122,865. Now, we need to split it between paste and NCI. Now, we're going to do that. We're going to hold on to that one for a minute. We're going to actually calculate that in answering Part D. So let me do Part D next. So in Part D, it asked us to, it says, what would the investment income be had Paste used the equity method? So if they used the equity method, this is how much investment income. So first, let's start with the first sub, which is waste. What was waste income? It was 104. Okay? Now, let's analyze our intercompany profits. So waste sold, the profit that we held back, now we're going to realize is 2,700. So we're going to add 2,700 for beginning inventory. Remember, this is December 31st, year 6. So this is letter H. Now, waste also sold, and there was profit that was held back, wasn't it? 10,800. So let's take that away. I'm going to label that I. And hold on, didn't we have an amortization of acquisition differential of 1875? So let's take that too into account. And that gives us 94,025, and 80% of that is our income. Okay, it's going to be our income. But check this out, you guys. How much of this is non-controlling interest? So NCI then is 20% of 94,025. And that is their proportionate share of that income. So I'm going to try to calculate that for you. I've got 94,025 times 0.2 is 18805. Okay. Next, let's look at the second sub. It's based. What's the profit? The profit for base was 9,000. Now, what was the intercompany transaction? Well, we've got base selling. There was $16,200 of profit that we need to hold back. So ending inventory, unrealized profit. And what about the amortization, you guys, of AD? Well, there are none, right? So there's no AD amort because goodwill was already written off, if you remember. Times 80% gives me minus 5,400. So the equity income, okay, is going to be 5,400 less 75,220, it's 69,820. But hold on. Wasn't there intercompany profits too? Pace sold, it was a downstream sale. We need to take that profit out as well. So we need to subtract paste, interco profit, elimination. And that would have been minus 3960. And our overall profit is 65,860. This is the equity investment income under equity method. Now, how much of this? So 20% of this is NCI, isn't it? So 20% of 7,200 times 0.2. Oh, sorry, it's 25% because we own 70. So this is 75%. I apologize. And this is 25%. Actually, that number is still correct. Okay, so 25% of 7,200 is 1,800. Okay, now this is the investment income. So let's go back to that question. It says how much of this income belongs to paste and waste. So we know that the non-controlling interest is 20% of 94,025 and 25% of minus 7,200. All of that adds to 17,005. So we're going to take that, subtract that to give us the paste, which is 105,860, which is 122,865 minus 17,005. That's how we determine the non-controlling interest. Okay? Now, Part B asked us, we're almost there. Part B asked us to prepare a consolidated retained earnings. Again, as of December 31st, year 6. So let's start with the retained earnings of PACE, the parent. We were given that. Remember, we were given that on the second last bullet point, all the retained earning balances. So that one is 703, 750. Now, remember, we had that profit that PACE sold, right? Remember, PACE selling, we need to eliminate that because this is the retained earning of the entity at the legal level. So this is profit unrealized PACE selling, and that is minus 3960. Okay, let's start with the first sub. Retained earnings of waste. And that was given to us, 146. We need to have retained earnings. So this is 12/31 year 6. We need retained earnings of waste the beginning of the year, wasn't it? We bought it on January 1st, year 1. That was the acquisition date, and that was 40,000. So we know that we've accumulated 100,000, 106, sorry, 106. Now, we've got to take away the ending inventory unrealized profit. So ending inventory unrealized profit. And that would have been 10,800. And the acquisition differential amortization, remember that? And we saw that acquisition differential would have been 93.75 plus the 18.75 altogether. So this really adds to 11,250. So let me just write those down. 37.75 plus 18.75. That would have been 11,250. Add this up, you get 83,950 times 80% gives us 67,160. So this is waste. And now we're going to analyze base this time, right? So retained earnings as at 12/31 year 6, we were given a 79,000. Retained earnings at acquisition date, that was 80. So the net difference is 1,000 minus. Now, was there any profit? Yes, there was, right? There was base selling. Profit was 16,200. Okay, 16,200. So ending inventory profit. Unrealized. Now, what about AD? Yes, remember goodwill was written off. We need to take that into account. The 19,000 goodwill write down. Gives us 36,200 at 75% gives us 27,150. So the consolidated retained earnings as at December 31st, year 6, is $739,800. Now, you're probably wondering, how come when we're calculating the consolidated retained earnings, that was the question, we did not incorporate the elimination of the beginning inventory, but yet when we did the consolidated net income, we actually factored this profit that's now realized. And the reason why is because these retained earnings are from the legal statement. So if you think about it, these are legal statement retained earnings. And these legal statement retained earnings would have included that sale, would have already included that profit, it would have been already part of the retained earnings. And therefore, we don't need to adjust when we're doing the consolidated retained earnings, we don't need to adjust the beginning profit that's now realized this year. And that's the reason why we don't adjust. But for consolidated income statement, we do. Okay? Great, thank you.